Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. 44th record high. Stocks take a breather this morning ahead of the start of third quarter earnings. The bar for pausing, it's the countdown to CPI with an FOMC that says it's in no hurry. And Hurricane Milton sweeps through Florida, making landfall, leaving 3 million homes and businesses without power. We are live from Tampa later this hour. It's the October surprise that nobody wanted. It is a devastation in Florida. We're going to be covering that throughout the hour. Elsewhere, we are waiting to see whether CPI delivers another form of surprise. That'll be coming in about 3.5 hours. In the meantime, equities taking a break from the gains from another record high, 44th. The risk was on fire yesterday in a good way. 44th record high. Spreads for IG go into the tightest since 2021. We're down across the board. It is small caps that are leading the losses this morning, down 0.4%. Bonds elsewhere, we did see yields higher after a more hawkish FOMC. It did seem that there are more participants who argued for a 25 basis point cut, but Powell leading the way. The front end, that is gaining somewhat this morning, basically unchanged. We are above 4% across the year. Your 10-year yield highest since July, 4.07% is where we stand. Dollar also taking a breather this morning, but actually slightly higher, but it's been higher for 8 straight sessions, its longest winning streak since 2022. So you had FOMC minutes yesterday. You also had plenty of Fed speak, a lot of Fed speak this week. Among that, there was San Francisco Fed President Mary Daly. She was talking about what she sees as the path forward for the rest of the year.
We are just where I believe we need to be at full employment, not growing too fast, not growing too slow. And I am now quite confident that inflation is on path to hit our 2% goal. I think that 2 more cuts this year or 1 more cut this year really spans the range of what is likely in my mind, given my projection for the economy. But it's really important to put caveats with that.
Well, caution is certainly in the air ahead of the CPI data. 3.5 hours is when it will hit. Even though it's expected to show a deceleration in inflation, Fed speakers have been emphasizing the need for gradual policy. You heard there from Mary Daly. 10-year yields backing back up above 4%. Joining us now is Simon Dangoor, head of fixed income macro strategies at Goldman Sachs Asset Management. Simon, really wonderful to speak with you this morning. Do you think that caution is warranted? What do you make of the backup in yields?
Hey, Danny, thanks so much for having me on the show this morning. I mean, the backup in the yields makes some sense, given that the starting point we had going into the September payrolls that we got last week was really priced for some caution that we were moving more quickly into a deterioration in labor market conditions. And I think with what we got last week, some of those concerns have gone away. But we'd expect that yields will find some support here and investor demand will come in, particularly if we get something on the more benign side in the CPI report later today. Ultimately, we've now priced out a lot of that weaker growth scenarios, and we're still facing a central bank which is likely to cut rates a couple more times this year. We heard that from Mary Daly. I think we'd be more in the camp that it's 2 rather than 1. And underpinned by the fact that the underlying picture of inflation continues to look constructive.
Simon, how do you understand where the bar is? You think it'll likely be 2 more cuts, 25 basis points, I'm assuming. How do you understand how high the bar is to not go twice and to pause either November or December?
I think it's important to contextualize the starting points of rates, which I think means that the bar to going at least twice more in 25 increments is set reasonably low. If you look at lots of classic Taylor rule formulations for the Fed, and of course Powell has often referred to these, they still leave policy rates somewhat high, even after the 50 basis point cut that we have last month, compared to those Taylor rule specifications. So we think as we're in that phase, the next couple of cuts are something that have reasonably low bars. We thought it was interesting to see the minutes yesterday evening from the Fed. Clearly there was some caution around some of the members around going 50, and that really showed through in the dot plot. I'm not sure there was a ton of new information from the minutes from that perspective, but clearly the chairman is driving the bus here, and he's very focused on this risk management calculation, shifting from being very inflation focused, which was of course the picture for the last couple of years, to being much more sensitive to the labor market environment. We think in spite of that stronger jobs number that we got last week, the broad calculation of the Fed, or the characterization of the Fed, that any further weakening in labor conditions is unwarranted remains the case, and that will underpin this low bar to additional cuts this year.
So if the bar is low, markets pricing in, let's say, 20% odds just about that they don't hike, or they don't cut, rather, if I can get my words correctly, that they pause in the next meeting. How do you understand how big of a buying opportunity this is? Simon, for so long, over the past few months, we've heard there's reinvestment risk. You need to buy bonds. Yields are coming down. Simon, they've gone up. They're back above 4%. They've been going higher since before the last meeting. Is this the golden opportunity to get back in when yields are attractive?
I mean, everyone's dying for a directional call right now. We think certainly in a portfolio context, the value of owning duration alongside risky assets has improved. And that reflects what's gone on with the underlying inflation process, which is going to keep the Fed in an environment where they can respond to weakness if we see it. Of course, that should be bad for risk assets. We think we're in a world where bad news is bad news. And therefore, in a portfolio context, adding some duration makes sense, particularly in the front end of the curve. But we're very focused, and particularly in our global strategies, on the opportunities in relative value space. Because when you look across the world, different central banks are facing really quite different fact sets. If I think about here in Europe, the growth picture is considerably weaker than what we see in the US. Inflation has been disappointing in Europe this year in terms of how much progress that it's made, but we see under the hood more positive signs that we would expect some softening in that picture in the course of the coming months. And of course, if you look at, let's say, for instance, household savings rates, they paint a picture whereby policy conditions in Europe seem to be much more clearly tight than what we see in the US. So expecting the ECB to cut next week, expecting that they cut again in December, but really the juice might be into what's priced into 2025, where the risk is that they deliver much more than what's priced in. So thinking about these opportunities in a global sense, what's priced for Europe, what's priced for the Bank of England as well, relative to the US, is where we're trying to take more risk at the moment.
As you're judging European sovereign bonds versus Treasury, Simon, how much does fiscal policy come into play? You have a United States that, regardless of who's president, there's likely to be more spending. And where you are in the UK, a serious conversation about taxes. France is trying to set a budget. How does that differential play to you?
I think it's an important feature of thinking as well about the sort of risk distribution around these different rates markets. I mean, the debate in Europe is in many respects about how do we consolidate against an environment where over the last several years, the growth picture has been quite weak. Whilst in the US, of course, the growth picture has been better, but the view has been, how far can we sort of push what we can get away with in terms of fiscal policy? We'll see what we get next month in terms of the outcome from the election, but really under all the combinations that we might receive, no one's really advocating for a lot of fiscal constraint. You know, one of the things that's coming onto our radar screen as an interesting thing to add to portfolios is inflation-linked bonds. They've been very unloved over the course of the last couple of years, that made sense in the context of the Fed trying to drive inflation lower and focusing on those upside inflation risks. That's now shifted with the central bank focusing, as we discussed, on more balanced risks and risks to the downside against this backdrop of a reasonably resilient economy. And the fiscal authorities are likely to be continuing to push on more fiscal in the United States. So we see what's priced into the inflation market as reasonably undemanding, particularly as you go out the break-even curve. Of course, ultimately, when you think about places like the US, fiscal risk should probably play out as much in terms of how long-term break-evens are priced as anything else. And that looks like an interesting entry point portfolio for portfolios. Of course, as well, when you look at what's going on in the Middle East, having some inflation protection in portfolios is a nice buffer if we were to see the scenarios play out where oil prices move more meaningfully higher.
Simon, we're going to have to leave it there. Really wonderful to catch up with you this morning. Great to get your thoughts. Simon Dangoor of Goldman Sachs Asset Management. Let's get you some other top stories now that are trending on the terminal this morning. Donald Trump has laid out his latest tax proposal. This time, he says he would end U.S. income taxes on Americans living abroad. That would require congressional approval, though, to happen. The Committee for Responsible Federal Budget estimates that Trump's tax proposals would likely cost $10 trillion over the next decade. Sales of German-made autos are plunging in their biggest market. BMW sales slumped 30% in China. For Mercedes, the figure was a fall of 13%. Germany's car industry has just delivered a wave of profit warnings before those figures. Younger drivers in China are increasingly turning to homegrown brands that are perceived to have more advanced technology. Hedge funds have been cashing in on the recent rally in Chinese stocks. They sold a record number of them yesterday, according to Goldman Sachs. Funds didn't just unwind their longs, they also added shorts. Chinese equity market volatility is at the highest since 2016 right now, after traders in the country returned from a week-long holiday. Coming up, Milton strikes Florida. We're going to go live to the ground from Tampa to discuss the damage as it moves inland. And later in this hour, as we count down to CPI, we're going to catch up with Citi's Andrew Hollenhorst on what he expects from today's print and why a 50 basis point cut is still going to come this year. All that to come on your brief.
We've already directed the Department of Defense to be ready to provide active duty service members to support Florida after the storm surge if Governor DeSantis requests the help, which I expect he might, just like we did North Carolina.
That was President Biden speaking before the hurricane made landfall. Let's go straight now live to Tampa, Florida, where ABC News reporter Rena Roy joins us. Rena, we really hope you're staying safe there, along with anyone else who is left in Tampa. Just describe to us what's happened so far, what the ground looks like, and the damage that's been done.
Yeah, well, Danny, you can see behind me that it is quite quiet here this morning. Things have calmed down, but for hours, rain was just pummeling this area. The winds were whipping, more than 18 inches of rain falling in St. Petersburg alone. Milton making landfall as a powerful Category 3 storm just after 8 p.m. in Siesta Key, packing 120-mile-per-hour winds and spawning deadly tornadoes. The predicted storm surge up to 13 feet, flooding densely populated areas on the coast, including Fort Myers. Tornadoes devastating hundreds of homes. The governor says 9,000 National Guardsmen have been mobilized to respond to the storm, along with 1,400 search and rescue first responders. There are also 50,000 linemen on hand to help the now more than 3 million customers who are without electricity. Danny?
Of course, now comes the storm surge. Now comes potential flooding risk. In terms of what going forward, the response, what resources are available, what does the aftermath of this look like, Rena?
Right. Well, we know that the hurricane has now started entering the Atlantic Ocean. It took about 8 hours to cross the peninsula. So conditions have cleared out when it comes to that rain and that wind. So crews will be able to start getting out there as the sun comes up. They'll be able to start assessing the damage and seeing who might need help out there. As I mentioned, there are a lot of resources on the ground from the local, the state, the federal level. They are all working together to figure out what this state really needs to move forward in the coming days and weeks.
Rena, thank you so much. And again, we really hope you stay safe out there. That is ABC's Rena Roy. You can track the storm's path, map Storm Go on your Bloomberg terminal. Again, we're wishing the best for anyone else out there. Really just devastation and devastating pictures we're looking at a region that was already hit hard by Helene. Okay, coming up, we're going to take a look at what else is making headlines around the world, including the first call between President Biden and Prime Minister Netanyahu in over a month. All that to come on your brief. Good morning. This is Bloomberg Brief. I'm Danny Berger in New York. Let's get you some front page news, a look at what's making headlines around the world. Most pages leading with Hurricane Milton. The New York Times has this, that Hurricane Milton has destroyed the roof of the Tropicana Field Stadium. Just to give you an idea of how strong these winds have been, it is home to the MLB's Tampa Bay Rays. DeSantis had said before the storm hit that they would be converting the stadium into a 10,000-person base camp for post-landfall responders. It is not being used as a shelter, but images across social media of the roof of that, the fiberglass going throughout the wind. Okay, next up on the Wall Street Journal, TD Bank is facing a $3 billion penalty and growth restriction in the U.S. on a U.S. settlement. It involves a cap on U.S. retail banking assets. Now, those penalties follow a settlement with regulators over failure to catch money laundering. An announcement is expected on Thursday, that according to our very own sources. And we have this on our front page. Netanyahu speaking to Biden as Israel's Iran retaliation is looming. It was the first conversation between the two leaders since August. The call throws into focus Biden's limited ability to influence Netanyahu. Of course, one of the main ministers was going to come to the U.S., canceled that trip. Vice President Kamala Harris apparently was also included in that call. Joining us for more detail is Bloomberg's Jomana Bercecci. And Jomana, of course, this comes after Yoav Gallant was supposed to be in the U.S., and that trip was delayed. It also comes amid the awkwardness of that Bob Woodward book saying that Biden and Netanyahu had tense conversations. So what do we know about this one?
Yeah, well, this was the first phone call the two leaders had had in over a month. The White House put out a readout of a call which stated that the two had discussed many different topics, but namely Biden had condemned Iran's ballistic missile attack on Israel from last week, affirming the U.S.'s commitment to Israel's defense, also saying that Israel has a right to protect its citizens from Hezbollah. This is, of course, in reference to the conflict now that continues to expand in Lebanon, but then the U.S. also saying that there is a need to minimize harm to Lebanese civilians, especially in densely populated areas in Beirut. They also discussed the need to renew diplomatic efforts to release hostages held by Hamas and the humanitarian situation in Gaza. But what was not discussed a lot, or at least there wasn't a lot of detail disclosed, was vis-a-vis the potential Israeli reprisal to those Iranian ballistic missile attacks. And you've got to think there that is on back of some security concerns heading into what could possibly be quite an imminent attack, but also due to the complexity of the operation. What we do know is that the Israeli Security Cabinet is meeting tonight at 8 p.m. local time, and earlier today the Defense Minister Yoav Gallant said that Israel's strike on Iran will be lethal, precise, and especially surprising. And we also know that over the last couple of days, the U.S. has tried to exert diplomatic influence to prevent Israel from potentially striking on nuclear infrastructure and oil infrastructure, which could be quite disruptive, as we know, to global markets.
Jomana, we've also seen the Iranian foreign minister doing a diplomatic tour of sorts within the Middle East. He was in Saudi yesterday. What do we make of the significance of that?
Yeah, so this was very interesting, very notable indeed. The Iranian foreign minister has been doing a trip around the region. He was in Lebanon and Syria over the weekend, but then he went to Saudi Arabia yesterday. Some images were put out by the Saudi Arabian foreign ministry showing him having discussions with the Saudi Arabian foreign minister and the Crown Prince Mohammed bin Salman. And perhaps it serves to underscore the fact that some of these Gulf Arab nations do want to stay neutral in case of things really blowing up between Israel and Iran in the coming days, but also significance in the context of Iran and Saudi Arabian relationships, because it was only in 2023 that there was a mediation of sorts. By the way, that was brokered by China. And it was only in the last couple of years that the two have actually been engaging in diplomatic dialogue. And the reason this is relevant, Danny, is because some people say that should Israel choose to target Iranian oil infrastructure, one way that Iran could respond is by hitting oil infrastructure of U.S.'s allies in the GCC. And one of them, of course, would be Saudi Arabia. There is a precedent to that because Aramco facilities did get targeted in 2019. But we are in a different environment today. And that is why the meeting that took place between the Iranian foreign minister and those key officials within Saudi Arabia, I think, are quite notable from a geopolitical standpoint.
And we are in a moment where we are more than a year on of this conflict, Jomana. It has spread across the Middle East. We know Israel has appeared to up their campaign in Lebanon, with Hezbollah saying that they would back a ceasefire. Where do we stand on any sort of resolution to the conflict or even just lessening of it?
Look, the background to this, Danny, is Lebanon has been in a state of political stalemate for the last couple of years, a state of political paralysis. And many within Lebanon are saying that given the situation now and given the relative decapitation of Hezbollah, it's an opportunity for the government to get itself together and come out with a united stance on what should be happening next. We've heard language from the Lebanese Prime Minister in the last couple of days saying that they are committed to implementing this so-called Resolution 1701, which states that Hezbollah put down their arms and move up away from the border. But the question is whether these declarations are going to be enough to satisfy what on the Israeli side want to achieve, which is to fully restore security on their northern border. And at this point, it doesn't appear as though those ceasefire discussions are going anywhere as it pertains to Lebanon and Israel. And for the time being, the ground incursion continues, so do airstrikes, and then rockets also being fired from southern Lebanon into northern Israel.
Jomana, thank you so much. That is Bloomberg Horizon's Middle East and Africa anchor, Jomana Bercecci. In the meantime, oil continues to move higher this morning, up by 1.5%, off of the highest that it's been this week, but NYMEX crude around $74 a barrel. Okay, coming up, we're going to take a look at today's CPI. Coming in about 3 hours' time, we're going to catch up with Citi's Andrew Hollenhorst. All that to come on your Bloomberg Brief. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Manis is on a well-deserved break. Let's set your agenda. It is the 44th record high. Stocks, though, taking a breather ahead of the start of third quarter earnings. The bar for pausing, it's the countdown to CPI with an FOMC that says it is in no hurry. And Hurricane Milton sweeps through Florida, making landfall, leaving 3 million homes and businesses without power. As we survey the potential devastation from Hurricane Milton, we go now to these markets. S&P 500, NASDAQ 100, and Russell 2000 futures all moving lower this morning. Russell 2000 losing the most, with yields pricing higher yesterday after plenty of FOMC speak. Speaking of which, yields this morning, for the most part, they are calm. We're above 4%. Four-year, 10-year yield, the highest level since July. The front end coming back down slightly this morning, but still above 4%. The dollar, for what it's worth, is ever so slightly weaker this morning, but it is on its stronger for 8 sessions. That is the longest winning streak since 2022. Let's get back to our top story, though, this morning. It is Hurricane Milton moving off the coast of eastern Florida and into the Atlantic. Milton came ashore as a Category 3 hurricane, knocking out power for millions. President Biden spoke before it made landfall.
We've already directed the Department of Defense to be ready to provide active duty service members to support Florida after the storm surge if Governor DeSantis requests the help, which I expect he might, just like we did North Carolina.
Joining us now is Bloomberg's Brian Wingfield. Brian, what do we know at this moment in terms of just how much damage there has been as the hurricane made landfall?
Hi, Danny. Well, Floridians are now just waking up to assess the damage. The storm's center has moved off the coast of eastern Florida, but it's still a Category 1 hurricane with winds of about 85 miles per hour, and that's still pretty severe. It came ashore, as you said, last night as a Category 3 storm. We've got a lot of flooding damage, a lot of rain, maybe even more rain possibly than initially anticipated, and more than 3 million people are without power in Florida right now.
And then it's not the only risk. It's not like the risk is over. It is still concerns of storm surges, of a flooding. Going forward, Brian, what are we going to be looking out for in terms of what poses that biggest threat for Floridians?
That's right. So when this storm was approaching, everyone was concerned about the storm surge because, you know, Florida is relatively flat, and if the sea comes up onto the coast, that can really swamp coastal areas pretty badly. So we're going to want to assess what has happened in that regard and also see how much rainfall is causing flash flooding and things like that. Florida's an agricultural state, so we'll want to pay attention to what's going on there. And also, a lot of real estate is at risk on the Gulf Coast.
Brian, thank you very much. Yeah, those images there just really shocking, including the blowing off of the rooftop of the stadium, just showing you how strong some of these winds were. Brian Wingfield, thank you so much. Okay, as we assess the damage of that hurricane, we have some economic data to get through today. One of the other big stories, CPI, it's coming out later today, 8:30 a.m. New York time, so just in about 3 hours' time. San Francisco Fed President Mary Daly spoke on what she sees as the path forward for the rest of the year.
We are just where I believe we need to be at full employment, not growing too fast, not growing too slow. And I am now quite confident that inflation is on path to hit our 2% goal. I think that 2 more cuts this year or 1 more cut this year really spans the range of what is likely in my mind, given my projection for the economy. But it's really important to put caveats with that.
Meanwhile, Dallas Fed President Lori Logan also weighing in yesterday, saying a more gradual path back to a normal policy stance will likely be appropriate from here. I'm thrilled to say joining us now is Andrew Hollenhorst, Chief US Economist at Citi. Andrew, thank you so much for joining this morning.
Thank you.
So you certainly have that, balanced gradualism. That seems to be the word from the FOMC. You still think there's a likelihood we get a 50 basis point cut in December. So where is the bar for 50 basis points? What needs to go right or maybe wrong for that to come?
It's really about what happens with the labor market from here. Now, we've seen a huge shift in markets where a couple weeks ago, before we had the recent jobs report, all of the focus had moved to the labor market. We'd seen this slowing in the labor market, and the focus had moved away from inflation. Now, with the stronger jobs numbers that we had out last Friday, I think the market is going to be looking at these inflation numbers. I don't think inflation is the story, though. I think fundamentally the labor market is still the story. Now, we're going to have a really cloudy, to use maybe an appropriate term, labor market report for the month of October. We have these hurricane effects. We have strike effects. That's going to make it hard to figure out where the signal is relative to the noise. So it may take a couple more jobs reports to really understand where this is going. Once we see that, we think we'll see more slowing in the labor market. That could get the Fed back to that 50 basis point cut. But absolutely, right now, this is a market that's going to be looking for, is it 25 basis points or is it going to be a pause at some point from the Fed?
Just to go back to the idea of the hurricane, the complicatedness of the data. Not only is it that's the data report they're going to have in their hands before the next meeting, but it's also going to be shortly after an election. What does that mean for the Fed's response to have a data that's a fog already in an atmosphere that is a fog?
Yeah, so I think you kind of go back to what Mary Daly said in those comments that we just heard, where she said the economy is kind of where they want it right now. So that's going into this cloudy period and this election. They kind of feel like they have inflation on the path to 2%, and they have the labor market exactly where they want it. If the economy is where you want it, you want to be moving to a neutral stance in terms of your policy rate. Now, there are big questions about where exactly that neutral level of policy rates is, but I think what we've also heard from Fed officials is that nearly every Fed official thinks it's significantly lower than where they are right now. So the direction of travel is still lower. I think the question is, how quickly do they want to move there?
So I don't want to harp on last Friday too much, but we kind of have to. So if they're still likely to go 50 at some point, if the labor market is still the top concern, how much of an anomaly was Friday then? Yeah, so I mean, we have to talk about it, right? This was a potentially game-changing number if this is what's going on. Now, the issue with the number that we saw last Friday is we had the unemployment rate coming down. We had very strong payrolls. It looks broadly strong across the board. But that really stands in contrast to some of the other labor market data that we have. Earlier last week, we had the JOLTS report, and that has the hiring rate, that has the quit rate. Those are moving to some of the lowest levels that we've seen for the hiring rate in over a decade. We haven't seen hiring that low. So I think what we have to reconcile in the data now is, can we call it a strong labor market, or can we say the labor market is where we want it when we have hiring rates that are at a decade low? If that hiring rate starts coming back up, that would be the true soft landing. But that's not what we're seeing so far in the data. And that's why we think we'll see more weakness in the upcoming labor market data. But again, it's this issue of signal and noise. We had 2 weak jobs reports, 1 very strong jobs report. We need a couple more to figure out where we are. So in this atmosphere of trying to figure out what is signal and what is noise, and the data being confusing, causing the market to swing back and forth, does it then put on increased importance to, for example, bank earnings to come this week to get a sense of where this economy is? Yeah, I think that's something we're watching also. What's the corporate story here? We know that interest rates are coming down, and we were talking before about the Fed having moved policy rates to restrictive levels. The whole idea is to slow down the economy. The whole idea is to soften the labor market. So are rates coming down fast enough now to give an impetus to the economy, to cushion the economy? I think that may actually be a challenge, because if you look at 10-year Treasury yields, they've come down, but now they're back up again, right? We have mortgage rates that are going up again. So it's not that clear how you're going to turn around this slowing that we see in the labor market. On the mortgage rate part, because yes, they have climbed higher. I just wonder what that does to the psyche, and again, the ability to continue to bring inflation down. If you have a situation where they cut 50 basis points and the net impact was mortgage rates higher and tighter financial conditions.
Yeah, it's a really interesting scenario. We're watching what's going on in the housing market. We've seen a significant slowdown in the housing market. It looks like the housing sector is in contraction now. As interest rates come down, that should stimulate the housing sector, but we really haven't seen that demand pick up. And now, to your point, mortgage rates are higher again, so we could even get more slowing there.
Okay, so maybe not the greatest thing. I know CPI isn't, again, the main focus for you, but it is today. I know you have your core forecast is ever slightly so hotter than the consensus, 0.25%. Core is about to be 0.2. I just wonder how you get there, what that comes from.
Yeah, there are a few special factors that are leading to that stronger reading for CPI. And remember, we have core CPI and then we have core PCE, and the Fed tends to follow core PCE. We think that's going to be a little bit softer. That's what we saw last month. But remember, last month we printed 0.3% month-on-month core CPI, and it wasn't a big deal because everyone was focused on the labor market. I think today, if we print a stronger number, you will get some market reaction. Now, the November FOMC meeting, we're already pricing less than 25 basis points, pretty significantly less than 25 basis points, so a significant probability that they don't cut in November. You could see that pricing push further if we get a stronger CPI reading this morning. Now, do I think that that's fundamentally appropriate? No, I think they're going to cut 25 basis points. I think it's a pretty high bar for them not to, but that's just where the market is right now.
Is there a figure that could come in CPI that, I mean, it sounds like the bar is low to frighten the markets, but what would be the bar for CPI to change things for the Fed and maybe make you change your call from 50 basis points of cuts in December to 25?
Yeah, I think we need to see a couple stronger inflation readings. Remember, we've had 3 softer readings now. We have core PCE inflation on a 3-month moving average basis that is running below the 2% target. The one concerning factor actually is shelter inflation. That is what has stayed elevated. But we've heard from Chair Powell, we saw in the Fed minutes that Fed officials are ready to look through this stronger shelter inflation. They're saying rents are coming in slower now. As long as those rent increases are slower, they're confident that shelter inflation is going to come down. So I think we really need to see a couple months of upside surprises, and not just in headline, not just the fact that oil prices are higher, gasoline prices are higher, but that you're seeing that in the core, you're seeing that in the super core, and services excluding shelter.
Just in you saying we need a couple months of more data, it feels like, it's a world awash in data and it's been more confusing than ever. Yeah. And you keep getting these swings and narratives that are really driven by the data. What is your confidence that we won't continue to get those swings and that some clear pattern will emerge and we won't have kind of these one-offs that can shake things up?
Especially with these weather disruptions, I think we realistically are waiting a couple months before we have clarity on this. And that is typical when the economy is slowing down because you will have mixed data. You'll have weaker jobs reports, and then you'll have stronger jobs reports. And the market is going to swing wildly from recession concern to reacceleration concern, which is kind of where things are now. So I think we are in that environment, and it will take convincing evidence, which is a few more months of data.
Yeah, I mean, it's crazy, again, that narrative swing happens like literally in a couple days now.
Yeah.
Andrew, thank you so much for joining us. Again, CPI is coming 8:30 a.m. Eastern. That is Andrew Hollenhorst of Citi. You're watching Bloomberg. It's your Bloomberg Brief. Danny Berger here in New York. So we are less than a month away somehow from the U.S. election. I have no idea where the time has gone, but in this week's election brief, we're going to be looking at sectors that will have the biggest impact under a Harris or a Trump presidency. We are joined now by Nathan Dean, senior government analyst of Bloomberg Intelligence. Nathan, thanks so much for joining this morning. Look, it probably makes the most sense to start with tech because a lot has happened over the past few days. Mark Cuban, the surrogate basically for Harris, saying that Lina Khan should be gone from the FTC. The Democratic Congresswoman from New York, Alexandria Ocasio-Cortez, tweeted this yesterday. Anyone who goes near Lina Khan and there will be an out-and-out brawl, and that she is a promise. She proves this administration is fighting for the working people. It would be terrible leadership to remove her. Nathan, as we understand the path for technology forward, you've done a really great job of basically running screens, what companies will and will not be impacted. How are we thinking about big tech as we head into the election?
So I think the current viewpoint is that no matter what happens in the election, at least for a short term, you're going to get status quo in terms of antitrust scrutiny and this heightened awareness of what's going on in the tech industry. Now, to Lina Khan's point, or Representative Ocasio-Cortez's point, we think that if Vice President Harris wins, Lena Khan probably will stick around for a while at the FTC. The reason being is that more than likely than not, or at least what the polls are suggesting, is the Republicans are going to take the Senate. And if it's the case, they're going to be able to jam up a lot of her appointees. And, at that point, if I'm Vice President Harris, why would I not want to spend, let's just keep Lena Khan where she is. So we think that type of scrutiny is going to continue. The big question mark, though, is if President Trump wins, because Senator Vance, the vice president candidate, came to the Bloomberg office a few months ago and called Lena Khan the best thing that Biden has ever done, and even insinuated that President Trump should keep her on. Now, I don't think that's going to happen, but if this idea of economic populism gets into the White House, you could see a tech industry that has the same level of scrutiny, when a lot of folks out there, I think, are presuming that you may get a big business friendly type Republican president. We just don't know. But what we are telling our clients is that, these court cases are going to continue. Probably if President Trump wins as well, you don't think you're going to see a dramatic change, but you need to be prepared for this tough scrutiny of the tech sector to remain for at least 4 more years, because it looks like it could happen.
Well, it's not even just tech that J.D. Vance had been aligned with Democrats on. I mean, he partnered with Elizabeth Warren on legislation around banks, trying to trumpet not just small tech, but small tech too. How should we understand the future for financials then, Nathan?
Yeah, so it's really coming down to this rule called the Basel III Endgame. Now, this is a proposal from the Fed, the OCC, the FDIC, which, as currently outlined, would increase capital requirements around 9% for the Bank of America, JP Morgan's, the big banks. The small regionals, you're looking around a 3 to 4% increase. Now, if Vice President Harris wins, this rule can continue. We think a reproposal is likely, probably next year. You're looking at finalization in 2027 or so forth like that, maybe the tail end of 2026. But if President Trump wins, this rule is probably indefinitely delayed. And the reason why this is important is because the Americans are the last piece of the puzzle to this. Europe has already implemented this via the Basel IV Accords, and the United Kingdom in particular has delayed implementation while the American regulators try and figure out what's going on. So if President Trump wins, those American banks probably won't get hit with that 9% capital increase, but you could see a race to the bottom across the globe as the global Basel framework, at least the last remaining piece of it, begins to unravel. So certainly interesting things to play, and this is one of the bigger catalysts of the election. Will it happen or will it not?
Nathan, if we could just round it out with the Inflation Reduction Act and what renewables will be doing. This is one of those sort of clean plays that people like to talk about in terms of the difference between Harris and Trump. What are you telling clients to watch out for in that sector?
Yeah, so this is going to happen in probably the tail end of 2025, and it's going to come as part of the tax reform debate we see here in the United States. If you remember, the Trump-era tax cuts for individuals expires at the end of 2025, and both Vice President Harris and President Trump do not want to see that increase for most of Americans. And the reason why the Inflation Reduction Act is here is because it's going to cost Congress somewhere between $3 to $4 trillion to extend those tax, that tax relief. And the Inflation Reduction Act could be a place for Republicans to go after in terms of cutting, tweaking, or help paying for it. Now, our base case scenario is because of a lot of the CapEx that's coming into the United States, into the renewable industries, so for companies like First Solar, combined with the fact that a lot of politicians at the state level in states like Alabama, Georgia, and Louisiana are liking these plants coming in and being built, we think the IRA is somewhat cemented, even if President Trump were to win. But you're certainly going to see a lot of headline risk, and maybe about the emissions or EV standards and so forth like that. You're certainly going to see a lot of headline risk as people just ask the question, can we cut the IRA to help pay for this tax reform? Ultimately, we don't think it's going to happen, but certainly something we have to pay attention to.
Nathan, we really appreciate it. Nathan Dean, Senior Analyst for Government and U.S. Policy at Bloomberg Intelligence. Really recommend looking at his work on the Bloomberg. Okay, in other election news, former President Trump is addressing Americans living abroad. He has a new tax proposal. The Republican nominee writing in a statement, quote, "I support ending the double taxation of Americans overseas. Currently, expats must file taxes to the IRS when where they live. In the country, of course, that would require congressional approval for something like that to be passed." Okay, it is the start of earnings season. Delta will be reporting this morning. Investors will be watching where demand stands. Of course, there was that CrowdStrike glitch in July that led to thousands of canceled flights over the 5 days. Whether that's having any impact, let's get straight to Benedict Campbell, who leads our global coverage of the aviation industry. Benny, just set out the expectations for us for Delta this quarter.
Yeah, you really set it out there already. We have a tale of two stories here, of two sides. We have the positive development in terms of pricing, in terms of demand, and that's something that will feed through to the numbers. So the environment is actually looking pretty good for the aviation industry at large, and for Delta in particular. The fuel prices are relatively low right now. That's helping them. The load factor, so how many people are on a plane, that's edging up to about 90%. So all of those metrics are actually looking pretty good. But then on the other side, and you mentioned it there, we have the CrowdStrike debacle that happened in July, and that hit Delta harder than the competition. And those are the two sides that will be featured in the report today, and people will see how much of a surprise might the CrowdStrike incident still have. Most of the numbers seem to be factored in, but there might be some lingering issues there.
Benny, what are we expecting in terms of demand? Last quarter, I think many had been caught off guard with some of these airlines, despite it being the strong, booming summer travel season, reporting some demand that didn't quite live up to expectations. Is it going to be the same this quarter? Have things sort of cleared out? Is demand doing okay?
It feels that it's a little stronger now. There was the whole debate about, are we at an end of revenge travel? Is this slowing down? And it was across the board. It wasn't just airlines. It was also theme parks. It was hotels. It was long distance travel in particular. A lot of it depends on sort of the state of the economy. Do people feel confident to put those savings and that extra money towards that trip that is usually fairly expensive? But for the time being, it does look as if things have held up fairly well across the industry. Delta is typically the first airline to report ahead of its peers, so they're a bit of a bellwether. So there's a read both for the industry, the aviation industry, but also more broadly for the economy. That will be interesting to watch.
Benny, we really appreciate it. That is Bloomberg's Benedict Campbell. Again, Delta earnings coming today. Coming up on this show, though, more economic data, more Fed speak. We're going to set you up for your trading day on this Thursday. You're watching Bloomberg Brief. Stay with us. It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Thursday. CPI, the main event coming in about 2.5 hours, 8:30 a.m. Eastern. We'll also get the latest jobless claims numbers alongside them, plus a whole lot more Fed speak. We're going to hear from Lisa Cook, Tom Barkin, and John Williams. And then Tesla will be unveiling its much-awaited robo-taxi. 7 p.m. in California, 10 p.m. in New York is the timing of that event. Speaking of which, let's look at some stocks on the move. Tesla, it is the moment of truth for them. They're up 1.33% this morning. They're getting a boost ahead of that robo-taxi event. Pfizer to the downside, down more than 1.5%. Former executives decided not to be involved in Starboard Value's activist campaign. They've taken a stake against the drug company. CVS, meanwhile, Barclays has upgraded the stock up 1 1/3. They are putting it as an overweight, $82 price target, citing margins and cost. All right, that is it for your Bloomberg Brief this morning. Stay tuned for surveillance and CPI numbers coming at 8:30 a.m. Eastern.